Hello everyone, and a very warm welcome. Today we're bringing you a really comprehensive explainer on an absolutely foundational standard in accounting, IND AS 23, which is all about borrowing costs. We're going to unpack this whole standard top to bottom, making sure every single aspect is crystal clear. I'm absolutely thrilled to guide you through this, so please make yourselves comfortable and let's begin our learning journey together.
Let's kick things off with a very practical scenario, shall we? Imagine a company takes out a massive loan to build a multi-million rupee factory. Naturally, they're going to have to pay substantial interest on that loan while the construction is ongoing. Here is the big question. Does that massive interest expense immediately eat into their yearly profits on the profit and loss statement, or does it actually get added to the final price tag of the factory itself over on the balance sheet? Well, IND AS 23 gives us the exact rulebook to answer that.
Okay, let's dive right into this. Here is our roadmap for the life cycle of a corporate project. First, the core principle. Second, identifying a qualifying asset. Third, calculating the costs. Fourth, the capitalization timeline. Fifth, disclosures. And finally, IND AS versus IAS 23.
Starting with Section 1, the core principle explained.
So let's dive into the core principle. This is literally the foundational rule that governs everything else we're about to discuss today. Simply put, borrowing costs are the interest and other costs an entity incurs when it borrows funds. The core principle of IND AS 23 states that if these costs are directly attributable to acquiring, constructing, or producing a qualifying asset, they actually form part of the cost of that asset. This is what we call capitalization. All the other borrowing costs, they're just recognized as a regular expense. Now keep in mind this includes interest calculated using the effective interest method, which really just means recognizing the true cost of a loan over time rather than just the cash paid, as well as lease liabilities under IND AS 116 and certain foreign exchange differences.
Let's look closely at paragraph 6A, which deals with foreign currency. You see, if you borrow internationally, exchange rates are going to fluctuate. So how much of an exchange loss can actually be treated as a borrowing cost? The rule here is very strict. Your exchange loss adjustment cannot exceed the difference between what a local loan would have cost you versus that foreign loan. And if you record a loss and later get a gain upon settlement or translation, you can only recognize that gain up to the amount of your previously recognized loss. Basically, it keeps the books perfectly balanced.
Moving on to Section 2, identifying a qualifying asset. With that core principle established, we have to ask, what kind of assets actually trigger these rules? Well, the standard defines a qualifying asset quite strictly. It is an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. I want you to notice the heavy emphasis on the phrase substantial period of time. Look, if you buy a brand new laptop and turn it on, it's ready immediately, right? That is not a qualifying asset. But building a massive power grid, now that takes a substantial period of time, and therefore it fits the definition perfectly.
Let's rapidly run through the exact examples straight from the standard to contrast what makes the cut and what falls out of scope. Manufacturing plants, power generation facilities, intangible assets, investment properties, and bearer plants, yes, they all qualify. But what doesn't? Financial assets do not. Inventories manufactured repetitiously over a short period of time? Nope, they don't qualify. Assets already ready for use when you acquire them do not qualify either. Also, the standard specifically notes that you don't have to apply this to qualifying assets that are measured at fair value like biological assets falling under IND AS 41 agriculture.
Next up, Section 3, calculating eligible borrowing costs.
Now we reach the mathematical heart of our project lifecycle, determining exactly how much interest we can legitimately add to the asset's overall cost. The standard divides loans into two distinct types, specific and general. If you take out a specific loan purely to build a particular factory, the calculation is pretty straightforward. You take the actual borrowing costs incurred on that loan, and you subtract any income you made by temporarily investing those borrowed funds before you spent them on the construction. However, if you use general borrowings, meaning funds drawn from a corporate pool of various loans, you have to calculate a weighted average capitalization rate. This is essentially a blended interest rate of your corporate pool. You then apply that specific rate to the expenditures made on the asset. Just remember the absolute golden rule. The amount you capitalize can never, ever exceed the total borrowing costs the company actually incurred during that period.
But you might be wondering, what about the edge cases? Well, if a company operates in a hyperinflationary economy and applies IND AS 29, it must immediately expense the part of the borrowing costs that simply compensates for inflation. Furthermore, determining borrowing costs can get pretty complicated when financing is coordinated centrally across a huge corporate group. The standard clarifies this by stating that in some circumstances, it makes sense to compute a weighted average borrowing cost for the parent and all subsidiaries combined. In other cases, it's actually more appropriate for each individual subsidiary to use its own distinct borrowing rate.
All right, Section 4, the capitalization timeline.
So, we know what to capitalize and how to calculate it. But now we really need to understand the chronological journey. For capitalization to actually commence, 3 specific conditions must be met simultaneously. You must be actively spending money on the asset, actively incurring borrowing costs, and actively undertaking the prep work. So, the crucial point is, all 3 boxes must be checked at the same time. And note that the prep work, or activities, isn't just the physical construction. It also includes technical and administrative work, like obtaining permits.
Just a quick vital clarification here regarding that first condition we just mentioned, the expenditures. The amount of expenditure we apply our capitalization rate against is strictly the out-of-pocket cash, transfer of other assets, or assumption of interest-bearing liabilities. We absolutely must reduce this expenditure figure by any progress payments we've received, as well as any government grants received in connection with the asset, as guided by IND AS 20.
Okay, so once capitalization begins, does it just continue uninterrupted? Well, not always. An entity must suspend capitalization during extended periods where active development is suspended. During this time, the interest is really just the cost of holding a partially completed asset, so it simply gets expensed. However, you do not suspend capitalization if you are doing substantial technical or administrative work. And what's really fascinating here is the nuance of the standard. You also do not suspend if a temporary delay is a necessary part of getting the asset ready. Picture this. You're building a bridge, and construction is suddenly delayed by extremely high water levels, which is actually common in that specific region during the construction period. You keep capitalizing the interest. The delay is deemed a completely necessary part of the process.
Finally, we reach cessation, knowing exactly when to stop capitalizing. The general rule is to stop when substantially all activities to prepare the asset are complete, even if some minor modifications are still outstanding. But what if the asset is built in parts? Let's contrast a business park with a steel mill. A business park comprises several buildings, right? And each building can be used individually while the others are still being built. Here, you stop capitalizing interest for each building as it is completed. A massive steel mill, however, involves sequential processes. The entire mill must be complete before any part can be properly used. Therefore, for the steel mill, you only cease capitalization when the entire plant is substantially complete.
Which brings us to Section 5, Disclosures and Asset Write-Downs.
Moving to the end of the reporting period, we have to look at what must be communicated to the public and stakeholders. Sometimes adding borrowing costs pushes the carrying amount or expected ultimate cost of an asset dangerously high. If this amount exceeds the asset's recoverable amount or its net realizable value, which in plain English simply means what the asset is actually worth, the company must write down or write off the carrying amount according to other standards. In terms of public reporting, the disclosures are very strict. An entity is absolutely required to clearly disclose the exact amount of borrowing costs capitalized during the period, as well as the specific capitalization rate they used to determine that amount.
And finally, Section 6, Indian versus International Standards.
For our final topic, let's examine the subtle but vital differences between this Indian standard and the global framework. IAS 23 provides the global foundation, sure, but it actually provides no specific guidance on how to determine those foreign exchange difference adjustments we discussed earlier. To solve this, India added paragraph 6A into IND AS 23 specifically to provide that strict, step-by-step guidance. Additionally, the transitional provisions found in IAS 23 were removed from IND AS 23. Why? Because India sensibly decided to house all transitional provisions for first-time adopters centrally within IND AS 101.
Now, to ensure we are covering absolutely everything in the source material for all the accounting professionals watching us today, we must also note Appendix A. This appendix acts as a really handy integral cross-reference guide. It clarifies that changes in existing decommissioning, restoration, and similar liabilities under IND AS 16 property, plant, and equipment make reference back to this borrowing cost standard. It also notes that service concession arrangements detailed under IND AS 115, revenue from contracts with customers, intersect with these borrowing rules as well.
Which brings us to a really fascinating closing thought. Could the way a company accounts for its construction interest completely change how successful they appear on paper? The answer is undeniably yes. By capitalizing interest, a company essentially avoids taking an immediate hit to their current year profits, instead shifting that cost onto the balance sheet to be depreciated later.
Understanding IND AS 23 is exactly how you look past the paper and truly understand the financial engineering behind massive corporate projects. I really hope this thorough breakdown has made the standard clear and accessible for you today. If you found this explainer helpful, please do like, share, and subscribe to the channel for more deep dives into the concepts that shape our financial world. Thank you so much for watching, and I'll see you in the next one.